Investing money is a terrific strategy to build wealth, especially over a lengthy period. However, if you've never invested before, you risk making costly mistakes. Behavioral biases are a generic phrase for the two forms of investing traps: cognitive and emotional. When confronted with a particular issue, most people's biases go unnoticed. When it comes to investing, there is always the possibility of a range of outcomes, making it simple for investors to be caught up in these schemes. Many aspects of investment are beyond our power to influence. We may hope for the best, but it's impossible to predict the outcome. This means that biases are merely shorthand for making investing judgments. So, in this video, we'll talk about some of the traps you should watch out for and stay away from. Before we do that, if you are new to this channel, hit the subscribe button and bell notification icon to ensure you don't miss any of our videos. Number 1. Anchoring. Anchoring refers to a tendency to rely too much on one's initial assumptions. An asset's initial value can induce a person to make erroneous decisions if they hold on too tightly. For example, you may believe that a specific firm is successful and believe that purchasing shares in it is the best course of action to pursue. The concept may be incorrect at this time or in the future. Similarly, when an investor holds onto a stock for too long because they are anchored on the greater price, then the stock was purchased for when the stock should have been sold a long time ago. To avoid falling into this trap, have an open mind, be open to new ideas, and remember that even though a firm is doing well now, it doesn't guarantee that it will be successful tomorrow. Studies demonstrate that anchoring cannot be completely avoided even when people are aware of their bias and actively work to prevent it. Keep an open mind when it comes to new financial information, even if it contradicts what you learned about the stock at first. Number 2. Sunk cost. This is a way to safeguard your money from the consequences of your past mistakes. Failure to accept responsibility for your errors and the resulting losses might lead to this condition. Because they've already spent their time or money, people are more likely to stick with an investment that doesn't meet their expectations. In other words, this explains why people wear clothes they seldom wear, eat bad food they have to finish, and watch bad movies they have to sit through to the end. And that's why they hang on to assets that aren't doing well. It may be difficult, but you must come to the truth that you have failed or made a terrible choice. Don't wait until the price of the assets drops any further to get out of a bad investment. A piece of advice: to make it simpler to sell your investments before the situation worsens, don't get attached emotionally to them. Setting investment objectives is the best defense against falling into this pitfall. To increase their portfolio returns, investors should establish performance goals for their holdings, and if they weren't met, re-evaluate their holdings to determine where improvements could be made. Number 3. Pseudo-certainty. Investment risk aversion is also known as loss aversion. Risk-averse investors are more willing to take chances when they believe they will make money from their investments, but they are more cautious when they think they will lose money. They are prepared to raise the stakes to regain money but not generate new capital. Loss aversion may play a role in situations when the fear of losing money outweighs the opportunity for profit. The most common cause is a lack of risk-taking on the part of the investor to avoid any losses. As with any investment, there is always a degree of risk involved. Loss aversion prevents you from taking advantage of investment opportunities since you're afraid of losing your initial investment. Not taking enough risk is a prescription for catastrophe, but taking too much risk is also a bad idea. Put together a sensible financial plan and don't allow your feelings to influence your choices. Give yourself permission to feel a bit uneasy. Choose assets with a proven track record when deciding where to invest. Number 4. Superiority. also called the overconfidence trap. Many investors are overconfident and believe they know more than professionals and the market. You don't have to be an expert in everything to profit from a few pointers here and there. People who assume they are superior to everyone else are more likely to fall prey to the investing traps. They have inflated views of themselves while stuck in the superior frame of mind. In other words, they're so sure of themselves that they're willing to ignore sound counsel. Assuming they understand more than the market, an investor may lose a position because of this. They believe the stock will eventually rise in price because the market sees its value proposition. However, if the price continues to fall, the investor might decide to exit the investment and take a loss. If you're too sure of your investments, you might not set up the protection you need to keep your investment capital safe. You may make wrong judgments and take on too much risk, which will only lead to losses. Number 5. FOMO. It's a condition known as the fear of missing out. People tend to blindly copy the actions of others, a practice known as following the sheep. Sheep mentality refers to the tendency of an individual, in this case, investors, to follow and mimic what other investors are doing. They are affected mainly by instinct and emotion instead of independent thinking. Investors follow their investors possibly because they see them successful instead of making their own educated selections about where they'd want to invest. Some investors appear to believe that following the herd is the best course of action. As a result, if everyone else is exiting the market, they feel more comfortable doing the same. Don't rush into following the crowd without first conducting your own study. Before making a decision on whether or not to invest, think carefully about the investment and the fundamentals of the firm. Number 6. Irrational exuberance. Irrational exuberance, also known as overconfidence bias, is a propensity to misjudge our abilities and intellectual capacity. In a nutshell, it's the conviction that one is superior to oneself. In investing, confidence is considered a virtue in many situations, but it is a drawback in others. It is common for investors to assume that the past predicts the future and act as if the market is entirely free of uncertainty. You may want to consider working with an experienced financial advisor who can devise an investment plan that maximizes rewards while minimizing risk if you're new to investing. With the support of various specialists, you don't have to rely on yourself. Number 7. Confirmation. Investors might fall into the confirmation trap when they seek and pay attention to other investors or assets that corroborate their present opinions. It can also happen if investors keep getting advice from those who have made the same mistakes and continue to do so. In some cases, those hoping to make the proper choice this time around seek the guidance of others who have been there and done that before. Instead of relying on someone who provided you lousy advice, seek out other sources that can help you find good investment opportunities. Investors looking for or favoring information that confirms their preconceptions about an asset or strategy may overlook evidence that contradicts their assumptions. Investors are unable to make sound judgments because of this one-sided perspective. In part, investors' lack of rationality might be explained by confirmation bias, which can lead to overconfidence in the market's efficiency. Identifying confirmation bias as a problem is the first step in dealing with it effectively. Once they've gathered enough evidence to back up their claims, they should look for evidence to refute them. In other words, keep your mind open. Investing involves risk, but falling into one of these investment traps might put you in a much more precarious position than usual. You should do some preliminary research and figure out what works best for you. If you put even a few of these suggestions into practice, you will prevent the waste of your time and the loss of your money. And that's it for this video. Before you go, don't forget to like, comment, subscribe, and click the notification bell for more videos like this. Thanks for watching and see you next time.